Hi, I'm LaDonna Montgomery, and I'm here to talk to you about my investment strategy from Finance 695 from the EMBA Spring 2015 class. My investment strategy is profit margin versus stock price, a profitability investment strategy. The project goals for this assignment was first to present an investment strategy. Second was the testing of an investment strategy using data analysis in Excel. And lastly, determining the feasibility of the investment strategy. What is profit margin? Profit margin is defined as a measure of how well a company controls its cost. It is calculated by dividing a company's profit by its revenues and expressing the result as a percentage. The higher the profit margin is, the better the company is thought to control costs. The formula for profit margin is net income divided by sales. Investors use profit margin to compare companies in the same industry as well as between industries to determine which are most profitable. What is stock price? Stock price, or the value of a company, is the present value of its future cash flows. The higher the cash flows, the higher the stock price. This is because investors care about the cash flows and what those flows mean to them in the present. Now, the magic question. Is a company's stock price driven by its profit margin? As investors, what we seek is insight into the potential of future equity returns, or more importantly, recessions. What was discovered in this analysis is that peaks in corporate profit margins have historically corresponded, not surprisingly, with peaks in equity markets as seen in the next illustration. The chart below compares real profit margins to the S&P 500. As you can see, there is a direct correlation in the S&P 500 stock price index in 2000 in the tech bust. The stock prices dropped as well as the real profits as indicated on the blue line in the same time period. If you scroll over and look at 2008, there's also a drop in the stock prices that directly correlates with the profit as indicated in the blue line. Now, which companies used in my sample? They were all major retail department stores. I used 5 of them: Dillard's, JCPenney, Macy's, Kohl's, and Nordstrom. Information used in the samples were the stock price of each company dated from the last day of the fiscal year over the last 5 years. It is important to note that each company's fiscal year ends on January 31st. Therefore, the fiscal years included were 2010, 2011, 2012, 13, and 2014. The historical stock prices for each company was found using Yahoo Finance. The profit margin of each company was also calculated by dividing net income by sales as published in MarketWatch.com. The regression used for the 5 samples. The regression shows there is a correlation. The p-value is 0.01486 for the 5 samples used, indicating that there is a correlation between profit margin and stock prices. Profit margins over the last 5 years for these companies, as notated in this chart, 4 out of the 5 companies show an increase from 2010 to 2014 in their profit margins, with JCPenney being the only company showing a decline. Coincidentally, stock prices also reflect the same pattern. The same 4 companies show an increase in stock price from 2010 to 2014, with again JCPenney showing a decline as on the previous slide, with profit margin decreasing. In summary, based on the results from the regression analysis performed on these 5 companies, there is a correlation between profit margin and stock prices in the retail industry for major department stores. However, the nature of the industry should definitely be taken into consideration when using this investment strategy. For example, retail industries may produce different results than service-related industries because inventory levels will play a major role in sales. The conclusion. As we all know as investors, other components should be reviewed when considering companies to invest in. Some of the components include company's short-term solvency, financial leverage position, asset management, and their market value ratios. That is my investment strategy. I hope you enjoyed. Thank you for listening and happy investing.